Microsoft just beat earnings by $1 billion. Revenue hit $81.3 billion versus the $80.3 billion analysts expected. Earnings per share, 4.14 versus 3.91. Azure, their cloud business, grew 39% year over year. On paper, that's incredible. But here's the kicker. The stock dropped 12% in a single day, wiping out $350 billion in market cap. More than the entire value of Netflix gone in 6.5 hours of trading. So, how do you win and still lose? Let me explain. Imagine you're playing high-stakes poker. You've been raising all night. Everyone knows your hand is strong. Finally, you flip it. A full house. A winning hand. But everyone else cashes out because they realize you've bet so much that your future hands now need to be even better just to break even. That's Microsoft on January 29, 2026. Microsoft's revenue grew 17% year over year. Azure, 39%. Sounds amazing, right? But the pattern matters. Last quarter, Azure grew 42%. The quarter before that, 31%. Growth is decelerating. Markets don't price last quarter. They price the next 12 quarters. And at a PE of 30, Microsoft is priced for acceleration, not deceleration. Then came Satya Nadella's comment. Capacity constraints through June 2026. Translation, they could sell more, but can't build data centers fast enough. Sounds good, until you realize 39% growth might be the ceiling, not the floor. Microsoft spent $37.5 billion on CapEx this year, up 66% year over year. That's more than half of their 2010 annual revenue just on infrastructure for AI. CapEx doesn't hit the income statement immediately, but it destroys free cash flow, which is what investors actually care about. Example, Microsoft generated $28.7 billion in operating cash flow last quarter, but spent $11.4 billion in CapEx. 30% of cash flow gone. If CapEx keeps growing faster than revenue, the math is simple. You're spending more than you're growing. Think like an institutional investor. Revenue beats, yes. Azure growth decelerates. CapEx up 66%. PE ratio of 30. Even small deceleration and rising costs can trigger a 10% haircut on the stock, which is exactly what happened. $350 billion in market cap gone. Markets don't reward a winning hand. They reward future expectations. If the future looks less explosive than priced in, the stock drops. Even if the business is doing fine. Microsoft isn't alone. Google, Amazon, Meta, they're all spending billions on AI. But most of it is defensive. Microsoft isn't building AI just to make money. They're building it so Google doesn't steal market share. Defensive spending can destroy returns. It's an arms race. Everyone spends, but the economics might be worse than traditional cloud. AI infrastructure burns expensive GPUs that last months, not years. Margins drop. Earnings beats don't matter if growth trajectory disappoints. Acceleration greater than absolute growth. CapEx matters more than reported earnings when valuing a company. Free cash flow is king. Megacap tech is priced for perfection. Minor disappointments trigger massive repricing. Microsoft, the company, is fine. Azure is strong. Satya Nadella is competent. But the stock might be dead money for a year or two while business catches up to valuation. Good companies not equal good stocks. You can own Microsoft and still lose. Price eventually converges with value, and when it does, the adjustment can be brutal. If you're in megacap tech stocks betting on AI, ask yourself, are you investing because the business fundamentals justify it, or because you're afraid of missing out? Only one survives days like January 29, 2026.